Hey everyone, welcome back to the channel. FICO stock has tanked 20% over the last few months despite decent growth in their revenue and free cash flow on a trailing 12-month basis. In this episode, we're going to jump in and break down the earnings and see if this is a rare buying opportunity for FICO. I'll be using my investment analysis website, investmenthorizon.io, to analyze these numbers. If you want to follow along, check it out for free. The link is in the description. Fair Isaac Corporation, better known as FICO, is best known for its credit scoring system, which helps banks and lenders assess how risky it is to lend money to someone. FICO scores play a key role in loan approvals and are used in over 95% of securitizations, highlighting the company's strong market presence. Beyond credit scores, FICO also provides software that helps businesses make better financial and risk-related decisions. Banks use it to detect fraud and decide who qualifies for loans. Insurers use it to set policy rates, and retailers use it to prevent fraud and manage customer payments. Looking at their latest figures on a trailing 12-month basis, FICO has delivered their strongest revenue growth, growing over 15%, with revenues reaching around $1.8 billion, up from $1.5 billion in the previous period. Switching to the quarterly numbers, Q4 revenue specifically hit $440 million, a 15% jump on the same quarter in 2023. This growth was mainly fueled by robust performance in the scores segment. FICO's scores segment brought in $235 million in revenue for the quarter ending December 2024, up 23% for the same period in 2023. This growth was mainly driven by higher prices for its credit scores and an increase in application for home loans. Annual recurring revenue from the software segment as of December 2024 was $729 million, a 6% increase from the same period in 2023. Switching back to the trailing 12-month numbers, free cash flow also saw a significant increase, rising from $493 million to $679 million. A majority of this increase is driven by the increase in scores revenue, which has strong margins, so a lot of this flows through to the free cash flow. From a strategic perspective, FICO is focused on two key growth areas: raising prices for its credit scores and expanding its software platform. The company plans to increase mortgage score pricing and may extend this to auto loans and credit cards. The company also plans to scale its software platform and add new features and artificial intelligence to unlock new revenue streams. With FICO scores used in over 95% of securitizations, the company holds a dominant market position, which creates high barriers to entry for competitors and gives FICO significant pricing power. Since FICO scores make up less than 0.1% of the average closing cost of a mortgage, which can be upwards of around $6,000, price hikes related to the FICO score are unlikely to deter home buyers. An increase in the price of a FICO score from, say, $5 to $7.50 per score could drive major revenue growth and profit growth with minimal added costs to borrowers. Additionally, if mortgage applications pick up as interest rates stabilize or decrease, FICO stands to benefit from increased demand for its scores. Conversely, slower lending, stricter loan approvals, or tighter regulations on pricing could limit future growth. So why is FICO's share price down? Well, despite strong financial performance and fundamentals, FICO's share price has declined 20% over the last quarter. A significant factor is its high valuations, trading at 71 times its free cash flow. This premium valuation has a lot of future growth baked into it, and signs of slower than expected growth could lead to a sharp decline in the share price. Price growth has been significantly outpacing FICO's free cash flow per share growth over the last few years, with price growing at a compound annual growth rate of around 35% over the last 5 years, and free cash flow per share growing at a compound annual growth rate of around 15% over the same period. So the price has been growing at more than double the rate of the free cash flow per share, and we can see this deviation between price and free cash flow reflected in the price to free cash flow ratio. At these elevated levels, much of FICO's future growth potential is already priced in. Investors may now be reassessing whether the company can sustain the kind of rapid growth needed to justify its premium valuation. As a result, the stock may be pulling back to a level that better aligns with its actual performance. So is FICO stock a buy after this recent dip? Here's my take. FICO has a strong monopoly in credit scoring, with FICO scores used in over 95% of securitizations. FICO has strong fundamentals. Revenue and profit continue to grow at high single-digit, low double-digit rates on average. They're expanding their margins and returns on capital, with returns on capital now sitting above 40%, demonstrating a strong ability to reinvest profits efficiently back into the business to drive growth. However, at 71 times free cash flow, the stock is still priced well above its historical range. For this valuation to make sense to me, FICO's free cash flow per share would need to be closer to the average annual increase in price we're seeing of around 35%, which is significantly higher than the average 15% growth we've recently seen. At current levels, investors may be cautious about buying, especially if growth slows or the company fails to meet its high expectations. Any earnings miss or weaker guidance could cause a sharp decline as the market adjusts to a growth outlook that more aligns with the company's existing growth. On top of that, FICO's premium valuation leaves little margin for error. If the company struggles to execute its pricing strategy or software expansion, investors could react negatively, adding to stock volatility. So while FICO is a strong business with a dominant market position, at the current growth rate, I'll be waiting for the price to free cash flow to drop closer to its historic range before I consider entering a position. What do you think? Are you buying FICO at these levels, or are you waiting to see if the price drops further? Drop a comment below, and if you found this breakdown useful, hit that like button and subscribe for more deep dives. I'll see you in the next video.